Basis trade is a well-known arbitrage strategy that takes advantage of a difference between the price of an asset and the price of its derivative contract. Let's see how this strategy works in traditional finance, using crude oil as an example. An investor can buy or sell physical barrels of crude oil. They can also buy or sell crude using derivative contracts called futures. A future is an exchange-traded contract to buy or sell an underlying asset, crude oil in this case, at a specific price in the future. For example, the investor who buys a July oil future for $120 undertakes to buy physical crude for $120 a barrel on the future's delivery date in July. The investor who sells this contract undertakes to sell crude at that price. If physical crude is trading at a lower price, let's say $100 a barrel, there is an arbitrage opportunity. The investor could buy physical oil in the spot market now for $100 and simultaneously sell it in the futures market with delivery in July for $120. They would effectively earn an arbitrage profit of $20 a barrel. This profit is risk-free or market neutral because it does not depend on what happens to the oil price going forward. The investor has already locked in both the cost, $100, and the revenue, $120 a barrel. Note that we would also need to consider the cost of storing crude oil, financing costs, and certain other factors when implementing this arbitrage strategy. In efficient markets, investors would arbitrage away any opportunity for abnormal, risk-free returns. In our example, the spread between the spot and the next month futures price for crude oil is unlikely to remain as high as 20%. By entering the basis trade, investors would eventually cause the spot price to rise and the futures price to fall, thus reducing the spread and arbitrage profit. As a result, in efficient markets, risk-free strategies offer more modest returns, generally in line with returns on short-term government debt, also considered to be risk-free. Crypto markets tend to be less efficient than traditional markets and may offer better opportunities for a basis trade. Let's see how we can implement this arbitrage strategy in crypto. As with commodities, we need to buy spot coins and sell crypto futures contracts. For example, if spot Bitcoin trades at $25,000 and the next month Bitcoin future trades at $25,300, we could buy one Bitcoin and sell an equivalent number of futures contracts for an arbitrage profit of $300. We will use a particular type of a futures contract known as inverse or coin margin future. Coin margin futures are traded on some crypto exchanges and have the advantage of being collateralized by the underlying cryptocurrency. It means that the investor who takes a position in such a contract must deposit the relevant cryptocurrency rather than fiat money or stable coins as collateral to satisfy the margin requirements of the exchange. This allows us to use the very cryptocurrency that we purchase for the basis trade as collateral for our short futures position without the need for any additional capital. Let's look at the mechanics of a coin margin future. The nominal value of the contract is set in US dollars. For example, one crypto collateral fixed maturity Bitcoin future on Kraken has a contract size of $1 and its price is quoted in US dollars per Bitcoin. Let's say we sold 100,000 futures contracts at a price of $25,300. Since we have a short position, we will make a profit if the futures price goes down and incur a loss if it goes up. Suppose that after a few weeks, the futures price has gone up to $28,000. The loss on the futures will be calculated as follows. One contract is $1, so the nominal value of our futures position is $100,000. At the time when we established our position, it was equivalent to $100,000 divided by the entry futures price of $25,300 equals approximately 3.96 BTC. Currently, our futures position is worth $100,000 divided by the current futures price of $28,000 equals approximately 3.57 BTC. As you can see, the value of our position has decreased from 3.96 BTC to 3.57 BTC, resulting in a loss of 0.39 BTC. Now, let's look at how the basis trade works with this kind of futures contracts. Suppose we want to invest $50,000 into the basis trade using Bitcoin. Let's assume that the spot price of Bitcoin is $25,000 and the price of Bitcoin futures contract of our choice is $25,300. To establish an arbitrage position, we will purchase 2 Bitcoins at a price of $25,000 and simultaneously sell an equivalent number of futures contracts at a price of $25,300. We can calculate the required number of contracts to sell. 2 BTC multiplied by the futures price of $25,300 equals $50,600. Since the size of one futures contract is $1, we need to sell 50,600 contracts. Let's double check that both legs of the trade are equivalent. We will have a long spot position in Bitcoin, $50,000 divided by the spot price of $25,000 equals 2 BTC. And the short futures position of $50,600 nominal value divided by the futures price of $25,300 equals 2 BTC. Both legs of the trade are worth 2 Bitcoin and thus equivalent. We expect to realize an arbitrage profit of $50,600 minus $50,000 equals $600. This profit is market neutral as it does not depend on Bitcoin price going forward. Let's demonstrate that this is the case. We will hold our arbitrage position until close to the futures delivery date. During that holding period, the spot and the futures price will change. With liquid coins such as Bitcoin and Ether, the futures price tends to closely follow the spot price. The spread between the two may fluctuate over time, but on the futures delivery date, the futures price will always be almost equal to the spot price. When the futures approach the delivery date, we will close our arbitrage position by buying back short futures and selling our spot BTC balance for US dollars. Suppose that on the delivery date, the spot and the futures price is $22,000. Let's calculate our result on the basis trade. We sold futures contracts at a price of $25,300 and bought them back at a price of $22,000. Our futures position was initially worth 2 Bitcoin. The realized value of the futures position on closing is $50,600 nominal divided by the current price of $22,000 equals 2.3 BTC. As a result, we have a profit on the futures leg of the trade of 2.3 BTC minus 2 BTC equals 0.3 BTC. Adding this profit to our original spot position of 2 BTC, we now have a total of 2.3 BTC. To close our spot position, we sell 2.3 spot BTC at a price of $22,000 for total proceeds of $50,600. Since our initial investment was $50,000, we have made a profit of $600 as expected. We could assume a different spot and futures price on delivery, but as long as they're the same, our arbitrage profit will always be $600. We have now seen that the return on the basis trade does not depend on the direction of crypto prices. It is determined by the spread between the spot and the futures price. We earn arbitrage return when the spread decreases from the level at which we established our arbitrage position. We would generally hold our position until close to the futures delivery date when the spread is minimal. After entering the position, there might be periods when the spread widens, leading to a decrease in the value of the position. However, this is only temporary, as the spot futures spread will always trend to zero towards the delivery date. On the other hand, the spread can also significantly decline well before the delivery date. In this case, we can realize our arbitrage profits sooner than expected. In practice, execution of the basis trade strategy presents certain technical challenges. To establish, roll over, and exit a basis trade, the investor needs to trade 3 instruments simultaneously, usually on 2 different exchanges. Both legs of the trade must be equivalent to ensure that the arbitrage position is fully hedged. The required quantity of contracts and coins to trade, the effective prices, and the eventual return in the strategy will depend on the real-time composition of order books for the relevant instruments. These order books change constantly, and all the necessary calculations for the trade should be done in real time. We have developed the Cryptobasistrade platform to address these challenges. Our platform helps users implement Basistrade programmatically and track their arbitrage portfolios in real time. Join our platform and discover a systematic and market-neutral way to make money in crypto.